Hello, welcome back to WinFS Trading YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. In today's video, I'm gonna show you something that is very important and gonna change your life as a trader. The topic is block theory in Forex synthetic indices trading. Okay, you really need to understand the fundamental of this content before you can actually be able to make use of it in real life trading. A block has both retracement and impulse event. Use H4 to know the market direction. Also know the H4 event, impulse or retracement. You should understand which one is actually happening, which one is active, whether impulse or retracement. You can trade H4 retracement, but with close monitoring as it is retracement. Retracement cannot guarantee profit, so if you are trading it, then you should monitor the trade and be able to know whether to hold that trade long or not. Use M5 for entry. The win rate is near 100% only if you have a deep price action analysis, like if you have run deep price action analysis. Golden rule to obey, that should be a breakout from block. The length of the breakout should be 2 times or half of the height of the block. Try to map out the chart pattern that is necessary. You need to map out the chart pattern, whether there are parallel chart pattern or triangular chart pattern, and then you should obey them accordingly based on chart pattern trading criteria. Try to wait for equipotentials to happen, like double top or double bottom or triple top or triple bottom. Enter on a retest to the block or near the block or exponential moving average 50 or chart patterns or all of them. Like that should be confluences so that your signal will be strong. Okay, SL is always outside the block. Have a reserve equity to accommodate for fake outs or liquidity sweep. We can adjust by 50% to 100% of block height. Like you can adjust the SL, you can adjust the SL by 50 to 100% of block height in event of drawdown near the original SL. Take profits. Take profit at a risk reward of 1:1 for non-exponential, or close manually at 75% of full 1:1 profit target if price is near end of screen at least zoom level in M5 time frame. Okay, so when I say non-exponential, it means that um it's supposed to be exponential. I'm sorry. When I say exponential or ESP, it means that you actually uh closed or take profit, or you close the trades once you get 100% profit of your risk. Like if you risk $10 and you are running on a $10 profit, you close the trade. That is 1:1. Okay, and then you wait for another signal to enter for another trade without, like this time around you are risking both the profit and the original risk. So that's what I mean by exponential. I'm going to maybe talk about it as I read down. Don't trade against retracement that have not ended. You shouldn't trade retracement that have not ended. So it's a very serious matter. You should know when retracement is up. Is like you should consider whether retracement is ending or not. Don't trade fake out due to ranging market. In other words, if you see that market is ranging, whether in the H4 or in the 5 minutes time frame, you should not trade it. The EMA loop should have positive slope near the proposed buy entry. So if you want to buy, the EMA uh, loop should have a positive slope. So the EMA here, we should be using 50, 100, and 200 EMA. And negative, okay, this one says negative near the proposed sell entry. Okay, so the slope of EMA 200 before or after the loop cross is very important. For buy, it must be positive, and for sell, it must be negative. Note, moving averages here do not guarantee to profitable signal. So run the price action analysis for steady maximum success. You see, this idea is very, very powerful, and it has been used in Japan by Japanese trader. And if you go and check the history, he made a massive profit because of the idea. But I'm just developing the idea with high level techniques, because you see that I introduce types of block. We have like types of block theory trading. We have rollover or exponential and non-rollover. That is non-exponential. And then we have development on this idea, which is block optimization. Okay, if you want to go deep into this content, like if you want to really see this work in your trading, you need to become my patron, because I will be elaborating on this topic in the patron community, and you will actually appreciate it. Even the optimization and the block theory trading types, you will learn more about it and how to go about it. But to continue this video, I'm gonna go back to the chart to add some value to this video, so that you see that these things are really working. Okay, trading is a kind of stuff that is based on high level mathematical principles, of which kind of variation and probabilities and such thing. It means your success rate can actually be zero if you don't know what you're doing. There is high chances or tendencies to lose more money than ever than you make. And that's why I have two solutions to help a lot of traders. You join my VIP signal channels, or you enroll for my WFS courses to change your life. Definitely you need someone to make it in life. Okay, so I'm gonna add more value to the previous stuff I have said on the documents by opening the chart to see these things work here. And this is cash 300 index. Okay, on the document we are talking about block theory. So first of all, get the overall direction of the market. You go to the 4 hour time frame. This indicator, the moving average, we need three moving averages. The one and the red, the one on the red, the one on the red is 50 moving average. The one on the blue is 100 moving average, and the one on the black is 200 moving averages. Okay, so you need these three moving average to start. Now, that's what we call early um, events and late event and then middle event. The best, like the best place to trade, the best place to make the maximum profit is in the middle, or the during the post early event or post late event. Okay, post early event or post late event, or can call it post end event. So we have the beginning and the end. Say for instance, a market is going to start a movement from this point. Okay, this is the beginning, and then the end. This is the end point. Okay, can now see the beginning and the end point as accumulation and distribution. So trading during those period of accumulation and distribution is risky, unless when they're about to die off, then it's more reasonable. And then the best place to make more money is in the middle, because this time around you are sure that the market is going in a given direction. So all these things you have to put it into consideration. That's why I say watching this video alone cannot help you. You need to be in the VIP for you to actually succeed. Okay. um so I'm gonna continue this. Right now you see that the candlesticks are printing above the moving average 200, the black one. But this is just the early beginning. It's early. Okay. It's too early that there are high chances that the price action will still trade below the black moving average, making your signal analysis more difficult and unrealistic. Okay. But at least we have one condition, like at least we see it above the moving average for the moment. But the problem is that this is the beginning of, like, this is in beginning stage or early stage. Okay. Oh, actually we also have one break of structure here and another break of structure here. So these two break of structure also give us more assurance that uh, buyers are actually strong in this market. Okay. So let's be cautious and be careful in our trading or risk management, because this is just near the beginning. Okay. This is not the middle. Okay. um Now we can take this as like we can take this as being bullish, because the candlesticks are above the black moving average. So if we go back to the document, let's go back to the document and read it out. So here you see that use the hedge fall to know the market direction. So when the candles are printing above the black moving average, which is what we use for hedge fall, we are in the hedge fall time frame. When the candles are printing above it without cutting it, if it is cutting it, then it represents range period, like it's cutting. For instance, it's cutting like this, cutting without breaking level, and making some fake out and rejections. Then the market is ranging in hedge for, and you should do what? You should not actually trade it unless you are an expert. Okay. That's why in VIP you will see different calibers of signal that still win because we are expert in this game. And so here you have this one trading purely above the black moving average, meaning that it is now trending, right? So what you need to do right here is to go to the 5 minutes time frame. Okay, let me delete some of this object. You now go to the 5 minutes time frame to perform the block analysis. But before you start doing the block analysis in the 5 minutes time frame, you have to confirm that there is a crossing in the moving average loops half curves. Okay. When I say loop, it's because it's more than one moving average. So all the moving averages, which are three moving averages, they should cross, right? When they have crossed, that is the first uh, condition to be met. That's the first condition to be met. Okay. Then the next condition to be met, you should observe, like you should look for one break of structure. That is a strong resistance or support should be broken, which I map here. Now, when that happens, you are going to do what? Draw, find the high and the low of that structure. Starting from one of the level of the structure, you can locate the high. So this is the high. It must be immediate and at, like, within the proximity. Okay. So this is what we mean by block theory. So you cover the draw a rectangle from the low to the high of that candle that was of that region that we are, you know, broken, where the price breakout. Okay. So you cover it. This is the block. So you can see that the dimension of the block is the shape of the block is a rectangle, and the dimension is dependent on the location of the highs and the low from which the price breakout. And then when you cannot determine the width by extending it as much as you can. Okay. but the most important variable is the height. Okay, the width doesn't make any. The width is actually necessary because of you can use the width to actually know when the test will happen, and also know the number of reactions within those blocks, because the number of reactions inside that block determine the displacement and the peak that will be generated when breakouts happen. Okay, if the width is so long and so big, the breakout is going to be massive. But if the width is so small, the breakout might be long as well, but then the momentum is going to be high. Okay, because the range periods, because the block is taken to be a range. Okay, the block is taken to be a range. So when the ranging period is so small, the market is going to go into momentum, and that is very massive momentum. And most time the displacement will take a vertical path than slopey path. Okay, so you can see when the width is big or longer, then expect the price action to be noisy and full of retracements, and low momentum, but then you will still make the same profit, because the block theory is based on this idea, which I'm going to tell you, that inside the block we have a lot of indecisions, or the market is consolidating, even though another person will think it otherwise. Based for this thing to work, you have to assume that the block is region in the price action where buyers and sellers are just fighting each other with equal forces. Forces like action and reaction here are equal and opposite. Like both buyers and sellers are actually participating here, but they couldn't make any progress because the market is at equilibrium within this block. But immediately the price break out of this block, then we say the market is out of equilibrium, or the market is in state of motion, like the market is now trending, and that is when you will be positioning to make high level profit. And so here the way to enter is to wait for market to retrace near the block. As it is retracing near the block, that first of all, measure the height of the block. Measure the height of the block is necessary, because some of these breakouts will be fake out. So here we have 70p block, and then when there is a breakout, measure the height of that breakout as it's when it start retracing. Then start from where the retracement start and measure towards the block. So here we have 45 pips. Now, is 45 half of 70 or more than half of 70? The truth is that 45 satisfy the condition of uh, you know retracement, like breakout. I'm sorry, it satisfies because the 45 is greater than 35, which is half of 70. Okay, so this breakout is going to be valid. So you wait for a retest to the block, not necessarily inside the block, to the nearest boundary of the block, or to the moving average 50, any of them. Once that happens, you are going to be placing the trade, and then you are going to be putting your stop loss outside the opposite boundary of the block, which is the upside, because you'll be selling. Now the question is, why are we selling in this kind of loop when the hedge fund actually shows buy? Okay, we are selling even though the hedge fund shows buy. We are selling because of the event that is happening here. I'm going to show you when we go back to the top. You should understand this event. Okay, and that this problem of uh early event and last event. I'm sorry, late event. Early event, late event is pretty much good to trade like in a signal during the middle, or after the early event, or during the late event, because during the late event you will be free from consolidations and fake out springs and optors and all of that based on Wyckoff trading criteria. So right here, I said you should know the retracement and impulse event. Pretty much, you should not be trading retracement if you are not an expert, and you should only be trading impulse. But in this video, I was actually uh, having this signal in the during a retracement mode. So the market is retracing, but it was a deep retracement, because if you go to the hash for, you notice that this retracement actually started all the way from this level, and you know keep pushing from this level and keep pushing, and still break level. Okay, you see that it actually break this touch. So this retracement is a deep one, so you shouldn't be, you can trade it. So that's why I was able to come up with this. So this is a block. Okay, we are trading this block. So it's retracted, and then we enter the trade. And if we are doing this exponentially, like we are taking 1:1 risk reward, or maybe 75% of the full risk, 75% of 1:1 risk. You are entering this trade here and you are measuring 70 pips. So you are placing your take profit at a price of 37.95 because you risk 70 pips. So you wanna actually make profit of 70 pips. Okay. There is formula to calculate loss size based on risk and stop loss. All these are provided in the VIP signal. Okay. I don't know how I will actually help some people that are losing money in trading, but I think when I shoot video, I do it to help some people. Not necessarily because I really want to shoot the video. I just want to help some people. If you are going to forward this video to me and say you are touched, because you are touched after watching the video and you feel like you want to join VIP, I will actually give you 10% discount to have access to my VIP, because the VIP are very costly. In fact, apart from some other costly signal provider in US, this VIP signal, is the most costly VIP in Africa. So you should actually know the reason. It's because of the stress and the caution and a kind of high level technology we employ to get signals. Okay, so you can see that it played. We get the 70 pip, and then it's still deep down again. To in other words, if we are trading this non-exponentially, whereby you just place the trade and you target the maximum uh, take profit. So you see, basically we are generating 173 pips, close to 1:3 risk reward. Okay. But when we say it's nature here, we really need to actually mark all the blocks. What is a block? You're supposed to know. It is just a high and a low, and then you stretch the rectangle, okay? Then we wait for price to break out of this block. We measure the height of the block. Here, this block is basically 64 pips. So when the breakout happens from this block, we pretty much measure the height of the breakout. We have 19. We are not going to take 19. It's fake out. And you notice it's really fake out because during retracement, it's actually re-enter that block. Any retracement that re-enter a block is not is fake out. Yeah, the block supposed to be a kind of rejector. Once a breakout happen, price should not re-enter that block. It's just like a satellite trying to leave the Earth orbit into another planetary orbit. But suddenly, the gravitational pull uh, send the satellite back to the Earth. It means the force on the orbit is not strong. I'm sorry, on the satellite is not enough to escape gravity. Okay, so don't trade that stuff. Mathematically, I have solved the problem. So all you need to understand that you have to measure the midpoint of this. height. Measure it is necessary. That's the what you're gonna use for criteria. So this is start to point 5. Okay, so you really need a breakout that is way. So we have this break, this one break by 27. No, we also have another break. We have then we have a final break that really generates 65. So that is what we need. Okay, so we now say the break is real. Okay, so which block that lead to that breaking, you should be smart enough to know that the block is this one. This is the block. Let's check what let's which one block. Okay, this is the block that lead to that breaking. Okay, so inside this block, I told you that block will come with different dimension and all of that, and all these things have effect on the signal. Okay, so the height of this block is basically 24 pip. Very, we can call this a tiny block because it is the height is lower than what we see before. Okay, it's basically much lower. Okay, more than 50% lower. So when you see this type of height, very small height, you expect price to have high momentum. Okay, in as much as the width will affect the momentum of the output signal, the height actually affect it as well. You will know this because it shows when the height is small, it shows that the buyers and sellers inside these regions are fewer and the liquidity is small and volatility is also small. A lot of things are very, very close to zero. When such when we have zero events here, like the market is in equilibrium, expect the breakout to come with high momentum, and that's what happened. You can see there is not much delay. The market just spikes straight. Okay, you see, that what you call let me introduce this thing basically, as the first person to use it. Eh, since I price the movement is like a wave, or market action behave like a wave, there are a lot of infinite lines, wave lines, you know, that originate from the same level. They basically originate from the same level. They basically go back to the same level and you know, repeat the same process. So this line, the energy in this line is totally different. Every line have different energy, different momentum and properties. Okay, you see, very smart, very, very fast. You see, very, very fast. You see, there is no much retracement. It nearly have only one type of candle, bearish candle, and it was able to generate 69 pips. But basically, if you are trading non-exponential, you're actually targeting 24 pips. Okay, 1:1. So 24 pips, you see, 24 pips generated. And then if you are doing like non-exponential, then you are targeting 95 pip. Okay, is a level subject to discuss. Like this subject is a level, like is uh I'm sorry, is so big, like it's a complex subject that I cannot cover in one video. And if at all I will produce more videos, I will not put it on YouTube, like, or make it public. No, you have to be my patron to watch those type of content. Okay, thank you and bye for now.